Hey guys, it's Josh Brown. I am here with New York Times bestselling author and founder of the Bear Traps Report, Larry McDonald, who's also a friend of mine from the Wall Street scene of New York City. Larry, say hello to everyone.
Great to be with you, Josh. Good morning, good afternoon to everybody around the world.
All right. So Larry's here to talk about what he calls inclusion games. There's something incredible happening with Tesla. Tesla is probably going to be need to be added to the S&P 500. It's going to be a huge weight right out of the gates. We're talking about billions and billions of dollars worth of essentially forced buying by the trillions of dollars sitting in index tracking funds right now. Larry's got some really interesting information on how this could all play out. Stick around. I think you're going to learn a lot. All right, so Larry, you guys did this really interesting thing about inclusion games and the fact that Tesla looks like it's about to report an earnings quarter that's going to put a lot of pressure on the S&P 500 to make a decision.
Yeah.
They've left Tesla out of the index all this time. It's almost a $300 billion market cap. And now, with another profitable quarter, they can't any longer. So what's your take on that?
There's a number of criteria in terms of Tesla's going to meet the most important one, and that is the 4 quarters of profitability. They're definitely going to have a profit. So I think Tesla's gaming the system. It's very clear that it's a big game, and it's a brilliant game by Musk. But I think that there's so much attention, and videos like this are very important, and there's so much collateral potential damage to the indices. There's trillions of dollars of indices that track the S&P. So all of these indices are going to be impacted. So they may just wait it out for another quarter and put off the decision until next quarter. Like, they don't have to make the inclusion now, but there'll be lots of pressure on all sides.
Let's get into some of the numbers here that we're talking about.
Okay.
One of your analyst, Robert Van Battenberg, he's saying there's approximately $3.9 trillion of pure index capital following the S&P 500. These are mostly index funds, including the ETFs and mutual funds that mimic the index. Tesla's market cap is $278 billion, but Musk owns 18.5% of the stock. So if you just look at free float market cap, it's $220 billion. And then he has the base on the S&P's market value at $27.8 trillion. So based on that, he's saying Tesla should have a 0.8% weight in the S&P, and that would imply $30 billion of buying power from index buyers. And then he's saying every $100 on Tesla's stock price means $3 billion in additional buying power from index trackers. And of course, that could work on the way down too. So based on those numbers, I do feel that they have to decide something. They don't have to implement it in July. Implementation of index inclusion could come between now and the end of the year. Do I have that right?
Yeah, I think that makes more sense.
So how much of the run-up in Tesla's stock price do you think has happened as a result of people trying to front-run the S&P 500 inclusion?
I'd first want to say the Reform Broker blog that you wrote in 2014 opened my eyes to a lot of this. And you called it the endless bid, and it was incredible foresight, foreshadowing.
Oh, the relentless bid.
Yeah, the relentless bid. And it was like, at first I didn't know what you meant. And I'll never forget. It was like, you remember there's some things in life around your understanding of certain things. And it was like, there's a bunch of things that happen through a year and through your career. And that was, to me, the aha moment, like the light bulb. Like, that's,
wow.
I really wasn't aware of the power of the passive indices in 2000. Like, this was like 2013, 14, I think you wrote it. And so this whole passive game, since you wrote that blog, $2 trillion has come into passive asset management. And now the stakes are getting bigger and bigger and bigger, and the games are getting bigger and bigger and bigger, right? Because the inclusion process is so much bigger than it was before, because 0.08% of an index this big, with all of the passive money coming in and all the passive money that will come in the future. So the University of Pennsylvania did a study which we wrote about on our blog, the beartrapsreport.com. And all the studies that have done, the academics, God bless them, they're They try really hard to try to put this stuff into studies, but a lot of the studies were done well before, and also the New York Fed did a study. All the studies on inclusion games were done way before the passive explosion. But what they did find, especially the New York Fed, was that both companies and stock price appreciation in terms of earnings, a lot of it comes in the 12 to 24 months ahead of the inclusion. So this is not just Elon Musk. Companies, CFOs, these guys want to get rich. They have incredible lifestyles, and they want to really get into that S&P and be part of this bigger and bigger and bigger passive game. So they will typically pump up those earnings. And so what you typically see is a large move up in earnings, a large move up in stock price performance heading into inclusion, and then a pretty substantial fall off over the following 12 months. So in essence, the index is left holding the bag. And that's what... Are
you saying stocks upon being included tend not to do as well as they had leading up to the inclusion?
Yes, that's what the Fed and the University of Pennsylvania studies imply, and
not just in share price, but in earnings growth too.
Yes, in earnings growth especially, exactly, because the companies are really doing everything they can to get in there in those, and then there's a little bit of relief, right? So once you're in, there may be like a 12-month period of like, okay, we're in. This is a game changer for us because of all of the passive flows, and there's a little bit of a relaxed process. So this is clearly a brilliant game that Musk is playing.
Is there any way to say that maybe this time is very different? Because most of the time when you're talking about a company being included in the S&P, it's probably a $5 or $8 billion market cap. This is $300 billion. It's a company that's been publicly traded for 10 years, one of the most liquid stocks on the NASDAQ. And it's certainly not an unknown company that people are first going to discover. I think it's a very polarizing company that people have very strong opinions about in both directions. This isn't your typical inclusion stock, right?
Exactly. This is the granddaddy, the mother lode of them all. It's never been anything like this. And remember, this company, if you look at the high yield bond market and you just look at the investment grade market. So here's a really cool way to look at it in terms of, I like to look at the Bear Traps report. One of the things we'd like to do is look at cross asset flows. And we have a Bloomberg chat with hundreds of mutual funds, pension funds, institutions around the world. And we look at like how different asset classes and how different audiences are viewing a company. And for example, if you have a $300 billion market cap right now in the S&P, the yield on your bonds is anywhere between 20 basis points, maybe 40 basis points for a company like a Pfizer. That's a little bit more than 300 billion. But in that neighborhood, you're really talking about 45 to 50 basis points up to maybe 1%. In the case of Netflix, you have a 2% yield on their 5-year bond, 2.5, 3. So, but Tesla,
but a $300 billion market cap, you're in the top 15 stocks already. Okay,
exactly.
So you're talking about, these are literally blue chips. These are JP Morgan, Pfizer, Alphabet.
Exactly. And so if you look at the yield on their bonds in that group that you just described, Tesla's coming in at 4 to 4.5% on their 5-year paper. And these companies are 40 basis points to 1%. So you're talking about almost a 4% differential to where the bonds are trading relative to the equity. So the equity is in this $300 billion neighborhood, right? So it's a really high-end neighborhood, but their bonds are trading like they're in a little bit poorer neighborhood. So the bond market's just not buying this inclusion game, and the bond market's basically saying, okay, you guys have bid the stock up to this much, 300 billion, but the yield on this bond relative to other $300 billion companies is 2% to 4% more, and that's a real warning sign.
Is it a warning sign, or is it possible that yield goes down upon inclusion because creditors feel better about Tesla as a risk once it's, I mean, I know it's just being in an index. It's not really like a coronation, but isn't it possible that the bond market comes more into sync with other issuers of debt rather than the stock price having to go the other way?
It is a big stamp of approval, so for sure. But I think I think bond investors typically are not really relying on S&P. They're doing their own work. You know what I mean? They're real credit people. And
So what's the current yield on Tesla debt?
well, they have a callable bond. It used to be a high yield bond. It's it's right now 4.4%. So Johnson and Johnson's 52 basis points. Now that's a bigger company. It's 390 billion. But let's go down to like MasterCard, 300 billion, 60 basis points. Home Depot's at 280 billion, 43 basis points. Intel at 254 billion is up at 64 basis points, and Tesla is 4.4% for their 2025 paper. So it just something.
I still think it's a huge accomplishment, though, that Tesla, which has yet to have a profitable fiscal year, is able to sell bonds to the public at 4 and change percent. Yes. I still think that's pretty remarkable. I don't think there's any parallel to that in history. Now, I think a lot of people would say, well, look at the Fed. I think a lot of people would say, well, in the case of Tesla, actually the bond market has been wrong and the stock market has been right.
Yes.
Which I know is a very controversial statement, but people would say that.
Yep.
Tesla's going to report Wednesday, the 22nd. I don't want you to make any earnings predictions, but I think we all agree he has every reason to report a blowout quarter. And maybe some of the enthusiasm in the stock over the last few weeks is because everyone gets why. In addition to S&P inclusion, there's also the potential for a very big stock bonus or stock-based compensation. Could you explain a little bit about what you were saying there?
This is fascinating. So Musk, I'm just going to read from my notes because I want to make sure I get it right legally. Based on 2018 performance award going forward, Tesla has achieved its third milestone needed to unlock the first 12 tranches of stock awards to Musk, which they're about to achieve. The first tranche unlocks once Tesla has a market cap of 100 billion for 6 months, so he did that.
Mission accomplished.
And then allows Musk to buy 1.7 million shares at $350. Remember, this is a stock that's trading around $1,500. So he can basically buy the stock at $350, which means he locks in a $1.8 billion P&L profit to himself. The catch is
that's breathtaking.
It's incredible. It's absolutely.
When does he owe the taxes on that? Immediately or not until he sells?
Yeah, I think he has to hold the shares for 5 years. So
okay.
So that means right. it'll be very high net worth on paper.
But still, in this day and age, you could take that equity-based net worth and you can borrow probably an equivalent amount. They're doing it in $1 million wealth management accounts at every brokerage firm on the street. So it's almost as though you have the money when you can pledge that as collateral, right?
Yeah, exactly. But on the earnings, so we look back and we went back to last year. In the second quarter, they lost $400 million in the second quarter of last year.
No big deal.
But what's interesting is, Josh, and you like this. This year, they sold almost the exact same number of cars. So they sold it, but they sold them at lower prices. So this is fascinating. So they sold almost the exact same number of cars, but at lower prices. We have a global recession. They operated 2 car facilities instead of 1, which drives up fixed costs. So there's a lot of things pointing to a miss here, but it just shows you if they do make the numbers. Based on those, pretty reliable stats. I've got a number of really important analysts that I've known for years that have gave me those numbers. This is really implying some very creative accounting to reach the holy grail of this profit number that the company needs for this big bonus. And
you're not using the word creative as a compliment.
Well, as a former Lehman trader, I mean, and I remember I'm so grateful to you. My book came out. We have a book that's a New York Times bestseller about Lehman, but I tell my wife once a month, if we sell 1 million books, we'll break even on our Lehman stock. But my favorite part of the book was when we had 4 CFOs in 4 years. And I think one time in one of your blogs you called it musical chairs, musical CFOs, and it's like this same dynamic has been playing out in Tesla. It's like they've had multiple chief accounting officers. They need to get a certain result coming into this holy grail S&P inclusion, And lo and behold, it's very interesting that they've gone through nearly the same number of chief financial officers as Lehman did in the 12 to 18 months before Lehman went under.
I almost feel as though the index committee has to acknowledge the sheer size of Tesla within the US stock market. But what if they didn't? What would that say about what the S&P 500 is? Could you truly call it passive investing if they ignored a $300 billion company and it had no market cap weighting in the largest 500 stock index whatsoever? Like, what would that say about passive investing if they ignored it?
So if they pass on the entry,
Yeah, let's say.
well, it definitely would say that kind of what we're getting into in this interview is, and it's kind of I like discovering this with you together on the interview, but it's like we're reaching a point where the passive game is so big, and this turn of events where normally a company would come into the S&P at maybe 75 to 100 billion, maybe 50 billion, to come in at that level, it's almost like if they don't put it in, it's saying that this is the company that broke the passive back. Like it's almost like too big a number to swallow. And to your point,
Right. It becomes more actively managed than anyone thought it was if they were to say no in a situation like this.
yeah. I see what you mean. Yeah, exactly. That's taking away. Yeah, now I see. Yeah, you're taking away the passive element of the automation of the mathematical certainty, right? And that's all
Right.
kind of coming away. So yeah, it definitely says something about the size and quantity of the passive world.
I think the other thing that it does, which we won't get into now, is just I think it takes this idea of profitability and makes it not optional, but I think every company in the world is following the way this story is developed. And I think the big takeaway is we have plenty of time to worry about profits so long as we build a rabid fan base for both our product and our stock. Like, not that that's easy to do, but it's an alternative to having to show a positive profit in the early stages of a company. And we know that from other situations, but Tesla seems to exemplify it. All right, Larry, where do you want people to find your stuff? I get the Bear Traps report emailed to me every week. I love it. Is beartrapsreport.com the best place to check you out?
Yes, it's thebeartrapsreport.com.
Okay.
And I'm really proud of this, Josh. We have now tripled the business over the last 3 years. It's essentially, you were part of the democratization of information. So when I was a retail broker years ago in the 90s, I wanted, I always felt like, in 1994, I was working on Cape Cod as a retail side, and I always felt like, I was getting information second, third hand. And so now what we've done is we have an institutional chat with 500 institutional investors. And what I like about them is there's different skill sets. There's 2 or 3 people that are really strong on equity volatility. There's 2 or 3 high yield managers, a number of really good foreign exchange people, and Eurodollars rates and the like. And so what we do is we recap that chat, kind of the most compelling takes that are coming out of the institutional chat, and send it to high net worth people, financial advisors like yourself. So,
yeah,
I want the Josh Browns of the world, the financial advisors, to have, really that front row seat into that institutional platform, and that's what we're trying to do.
Well, I think you do a really great job. I
Thanks.
love reading your stuff. One of the reasons I like it so much is because you actually have an opinion. You're not just saying, here's some data, choose your own adventure, which there's nothing wrong with that either. But I think you do a really good job at saying, look, this is what we think, and here's all the data that backs it up and why this is our opinion. And I think people really like that. So I appreciate you coming on. Everyone will check you out at the Bear Traps Report. Follow my friend Larry McDonald. He's also on Twitter. Are you at ConvertBond?
At ConvertBond, yes.
All right, we'll hit you there too. Hey, let us know what you think about Tesla, the S&P 500 Index Committee, and this stock being the straw that broke the active passive debates back. Would love to see what you guys think. Go ahead and subscribe to the channel if you haven't already. Give us a like. We will be back with you very soon.